Good afternoon, good evening, good morning, wherever you happen to be, and welcome to the Valutrades webinar on trading in inflationary times. When the marketing people at Valutrades said, let's do a webinar on inflation, I said, this could not be a better time in the history of the planet to talk about inflation. Because why? Because it's really messed up. So hopefully we'll go through this webinar and you'll have lots of questions, and we'll answer more questions than you have, I hope. But let's put it this way, things are very, very different than they were before the pandemic, before the war, before whatever. So let's go through this hopefully entertaining hour on inflation. Looking forward to hearing your questions. And we're going to be looking at what it all means, what types of inflation there are, and how to trade them. Right, my name is Brad Alexander. If you're a regular viewer of Valutrades videos and webinars, you should know me by now, I hope. I'm a trader, professional, and retail. I spend my days providing content to brokers and fintech companies, and my favorite client is Valutrades. I work for, like I say, a lot of fintech companies that do education, and I have Bloomberg on all day long, so I'm following inflation, I'm following interest rates, I'm following all the stuff that you should be following. Hopefully, if you don't have the time, then you need to watch the Valutrades Market Blast videos every Monday and Tuesday. So let's take a look at today's content. Before we do, let's talk about the disclaimer. If you're new to trading, please take a look at the disclaimers on the Valutrades website. CFDs and FX are leveraged products, and your capital could be at risk. So if you never risk as much money as you can afford to lose, don't trade speculatively, get some education, and there's lots of it on the Valutrades website and YouTube channel. And if you have any questions, just jump on the customer support chat line on the Valutrades website. Again, CFDs and FX are leveraged products, and your capital may be at risk. So, what does inflation mean to the person on the street? Well, we're not going to spend this entire webinar talking about that, because you know what it means to your daily life, and everybody on the planet right now knows what inflation means. Some people are hurting more than others. So basically, for a variety of reasons, our costs of living, our cost of doing anything, going out, putting petrol in the car, turning the gas meter on, is simply going up, and that is the basic definition of inflation. I mean, even well-to-do people are now talking about turning down the heat in their homes and wearing more sweaters, which is great for a lot of us. But some people are suffering because of inflation. There are people in many parts of the world who have to decide whether they pay rent or whether they buy more electricity or whether they turn the heat up or whatever. It's a very, very difficult situation we're getting into now, and I hate to say it to the person on the street, it's probably going to get worse. So we all know what inflation means to us. I mean, right now, every time we go out, we're spending more on stuff that we're used to maybe spending not so much on. Yesterday, I bought a lock for a door, very simple. A few years ago, I bought one for €7, and yesterday I paid €31. Obviously, the price of petrol or diesel for my vehicle has gone up. We're seeing more dogs and cats on the street because people can't afford to feed them. Everything's going up. It's crazy. So we're going to be looking at why that's happened. So, but we're traders. We're not regular people on the street, are we? Well, of course we are, but we're also traders. So we need to know a bit more about what's going on with inflation. But we need to start, what does inflation mean to the central banks? Well, the central bank's job is not to control inflation from the standard sense of the word. They can't control the price of goods and when they're coming into the country, but they can manipulate and modify certain economic conditions within an economic region to help mitigate inflation. And that's the job of the central bank. The central bank, if you've been following my videos for years, you'll know, has a juggling act. They have to balance wages, they have to balance inflation, they have to balance interest rates, they have to balance the currencies. And right now, we're all looking at the central banks to help us out. The central banks did an amazing job when the pandemic hit us. And I must say, if it weren't for the central banks, we could have seen huge global economic catastrophes. And they managed to keep us, between governments offering stimulus checks and so forth, and the central banks keeping everything under check, we managed to come out of the pandemic almost. And we're going to talk about that in a minute. So, what does inflation mean to the retail trader? Well, there really isn't sort of an inflation that you can trade. There's no inflation symbol on the Valutrades MT4 platform, but there are ways that we can take advantage of fluctuations in in inflation, and as I said earlier, what the central bank is going to do. And investors and analysts watch the central banks minute by minute to see what they're going to do with a variety of their tools. So inflation to a central banker is quite critical. I was asked recently on a webcam when sadly the Russian invasion of the Ukraine started, and I was on a panel of about 5 different people, and they asked us, is this the worst possible time, coming out of a pandemic and then invading a country? Well, my answer to that was twofold. First of all, Vladimir Putin does not care about pandemics. He just has what he has to do in his own mind, without going into a political rant. But the other side of the coin is the central banks were just getting a handle on inflation coming out of the pandemic. And then suddenly we're all dumped into this world-shaking war in the Ukraine. And it's going to have a serious effect on inflation as we go forward. And we'll be going through that as we carry on. So in this webinar, we'll be talking about a few things. And please jump on the question line if you have any questions you want me to answer as I'm going. I'm happy to stop and answer your questions. So we're going to be looking at the types of inflation. Inflation is like cholesterol. There's good cholesterol and bad cholesterol. And believe it or not, there is good inflation and bad inflation. Unfortunately, between the pandemic and a global, geopolitical event happening right now, it's a bit upside down. But there's such a thing as good inflation, and we'll talk about that in a minute. Right, measuring inflation. So obviously, we hear on the radio, we hear on the TV, we're at 10%. The UK is at 7.5% inflation. Is it transitory? Is it not transitory? The central banks have changed their tune. Andrew Bailey and Jerome Powell have really changed their tune in the last few months, but they have their own metrics. They know what they're doing in terms of measuring it, and there's a myriad ways to look at inflation. Right. I'm going to look at inflation from a post-COVID standpoint. I mean, we thought we had inflation under control. It was ticking along quite nicely. The economy was growing, and then COVID came along and turned our world upside down in a variety of different ways. And then coming out of the pandemic, and we're not out of it yet, I don't think, we've discovered some new economic realities that we'd never seen before, and we're trying to deal with those, and the central banks are trying to deal with those as well. So coming out of that, and as I said earlier, jumping straight into a very sad war in the Ukraine, which probably may have more dramatic effects on supply and demand and inflation than the pandemic had. So we'll take a look at that as well. So what do the central banks have in the way of tools, or what do governments, for that matter, have in the way of tools to help fight inflation? I remember, I'm a bit older than most of the viewers right now. I remember Jimmy Carter had these little buttons that says whip inflation now, and they did quite a few stunts to try and whip inflation now, and they basically didn't work. The central banks have learned, and governments have learned a lot more since then. So let's see if they can use those tools to help whip inflation now. And while you tuned in, trading. We want to know about trading. So how can we trade this inflation? What does it mean to a trader? What do we see on the charts? So as I go forward, I'm going to be spending a lot of time talking about, obviously, inflation and how it's measured. But as we go further into the webinar, I'm going to be going into more detail on the physical trading of it and what you as a trader need to look for. And it's not straightforward. It's not easy. It's like any type of news trading. But obviously right now it's very topical. I mean, not long ago, a few years ago, it wasn't a big thing on the radar of traders. Now it's huge. And we'll be taking a quick look at Valutrades signals, which we've talked about quite a bit. One of the things you need to know about signals is that the lovely guys, Joe and Steve and so forth, and the team who provide the signals with Valutrades, they take into account geopolitical events, inflation, interest rates, and so forth. So if you, as a trader, don't have time to be monitoring, like I do, Bloomberg and all the news and Yahoo Finance, and of course watching my videos and blogs, you can actually use Valutrades signals, and they will take into account for you all the volatility and all the exciting things that are going on behind the scenes with the central banks and governments to help you trade. So that's another way to do it as well. I find it more fun to dig right into it though. So let's take a look at the types of inflation. As I said, sorry, give me 2 seconds here. I'm talking too quickly. I'm not. there are a variety of types of inflation, some good and some bad. So demand pull inflation, that's a very interesting name. All of our industries have different jargon terms, different uh, words to confuse the public outside, but this is basically supply and demand. And that's dead simple to understand. Supply and demand is basically the bottom line of everything we do as traders. And here's a classic example going into the pandemic. The demand for crude oil fell out of the sky because we couldn't fly, we couldn't drive anywhere, we couldn't go anywhere, we couldn't go into a hotel. We simply, the economy in our lives simply ground to a halt. Therefore, the demand for crude oil dropped out of the sky, and it went from, whatever it was at the time, $70 a barrel down to, in fact, the 2-month contract was minus $45. So that was a classic supply demand. There was no demand for crude. There was lots of storage. In fact, you may recall in March of 2020, the biggest problem was where do we put it? They solved the problem by dumping all the crude oil in the States and sending it off by ship to South Africa just to store it. So you had the classic demand pull inflation, in this case, deflation, and the rules apply. And it's like anything. If you decide one day you want to buy a bicycle and suddenly there's a shortage of bicycles, the price is going to go up. It's that simple. And the thing we're living with right now, as you know, for the last 2 years, we've had a semiconductor shortage. So, and semiconductors are in everything. They're in everything from, your vacuum cleaner to your car. And the price of used cars has jumped up dramatically. And that was basically because of the next one we're going to talk about, which is cost push inflation. Cost push inflation is when a product becomes more difficult to produce. And here we have a classic situation where there were not enough semiconductors. The demand was higher than the supply, which gets back to demand plus, but the cost of producing a car became very, 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 very high, so the price went up. And also another thing that we're looking at right now, and I'm going to be touching on this very, very quickly, the price of crude and natural gas coming out of Russia has gone up dramatically, which has affected a lot of things in Europe. But what it also does, and I'm going to use an example of fertilizer. It takes a lot of natural gas to provide fertilizer, which is the very, very beginning of the food chain. Fertilizer creates crops or grass for the cattle, and it has gone up 3, 4, 5, 6 times the price it was a year ago or 2 years ago. So straight away, the cost to produce a product has gone up. So farmers now have to spend a lot more money buying fertilizer, which they have to pass on to their distributors. So the cost of the crop they're growing or the meat they're producing is going up, and it's a ripple effect right across the board. So we've got demand pull inflation, which is basically supply and demand, which we all understand. Cost push inflation, which the bottom line is when something costs more to produce, it goes up. But we also have in cost push inflation currency effects. So if you're right now, for example, in Europe, where the geopolitical event in Ukraine is happening right next door, the euro is falling, and unfortunately, the European Central Bank, are not really keen on raising interest rates right now, so the euro is falling. So anything that comes into Europe costs more. So that's part of cost push inflation, the currency, and most of us lived through Brexit with the pound falling, and suddenly with the pound being so weak, imports into the UK were very expensive, and that affected us as well. Now the pound is stronger, but for other reasons, prices are going up. And right now, coming out of the pandemic, we had the cost of shipping, logistics. They couldn't find truck drivers, as you know, couldn't get in LA and various other places. There were cargo ships waiting outside on the port. Even if they could get them into the port, they didn't have the truck drivers to move them around. Obviously, if you were a truck driver, you could glean a huge increase in your wage or your hourly rate, which again is cost plus and cost push inflation. All these things, shipping, fertilizer, all going up, they're passed on to the consumer. So that's what that is. Right. And there's built-in inflation, wage inflation. And this generally, before the situation we're in now, we would consider this to be the good kind of inflation. Basically, what was happening in built-in inflation was if costs go up, wages would increase with them. Everybody had a job, everybody was happy, and the economies were ticking along. So this built-in or wage inflation would include, as I said, your wages going up with the cost of living, very modest cost increases across the board, the economy growing, corporations doing well. And basically, that's the kind of inflation that you want. You don't want zero inflation or deflation. And basically, looking at that, the central banks like to see 2% inflation. You're going to hear that a lot. Right now, we are nowhere near 2%. We're looking at, in some cases, 6, 7, 8, 9%, even with large economies. So it's a big problem for the central banks. And here we have some nice pictures of the U.S. Federal Reserve, the Bank of England, and the Bank of Japan. And the Bank of Japan has recently had the opposite problem than the rest of the world. They've had deflation. They're sorting it out now, but that was really causing some problems because they really couldn't lower their interest rates anymore when they're at zero. So it was causing a lot of economic difficulties for the Japanese central bank. And the currencies, if you're trading the Japanese yen, the currency's been fluctuating quite a bit lately, and that's part of the problem. There was a differential. I won't go into details, but there was a differential between bond yields in Japan and bond yields in the States, and that's a big problem for investors. If the bond yields are higher in one economy, they're going to put their money there. And we have a new thing now, stagflation. So it's the antithesis of wage inflation. What we have right now on our planet, we have lower economic growth, we have higher unemployment, we have lower corporate earnings, and we have inflation going up, which in reality shouldn't be happening, but it is happening for all the wrong reasons. And this is a big problem. If you Google the definition of stagflation, you'll find there are quite a few different responses, but this is basically what you need to know. Economic growth is down, unemployment is up, corporate earnings are down, and inflation is higher. And the bottom line right now is we need to sort out our planet because there's so much uncertainty. If you caught my last few market blasts, we used the word uncertainty quite a bit, and that is the worst thing for an investor. So with uncertainty, investors will not be buying shares. If you've got bond yields going in the same direction as the share price, you've got nobody investing anything. You've got people holding on to cash, which means that currencies are going up in value. And depending where you are, if you're exporting or importing, that definitely affects inflation. Okay, let's take a quick look at the pandemic inflation. And it's something we need to know because we're not out of it yet. And the problem we had with the pandemic was because of social distancing and factories shut down. Basically, production was very, very difficult. So actually producing the goods or even getting the goods anywhere became very, very difficult. So that was definitely getting back to a supply and demand situation. So the pandemic didn't help us at all there. Higher cost of logistics. I was just talking about the lack of truck drivers and getting ships into the harbors to unload them was almost impossible. You probably heard the statistic that we heard about a year ago. Getting a Nike shoe out of a factory and then onto the shelves in the US, for example, was suddenly 10 times longer than it was before because of the pandemic. And all these costs have to be passed on to the consumer if you can actually get the shoes in that case. And again, that's getting back to supply and demand. So you have both types of bad inflation right there. The cost of production is higher, and then the supply and demand goes out of whack. Here we just see here the supply and demand is totally out of kilter because of the pandemic. And again, we didn't need that. We didn't need the semiconductor shortage as well. So we are living in a new reality and hopefully getting out of it. And I see ads all the time for companies building semiconductor factories all over the world. So hopefully within maybe a year or so, we'll be out of that particular problem. And a labor shortage. And there was a big debate over whether, especially in the United States, whether the labor shortage was real. And the Marty Walsh, the Secretary of Labor, says, "Oh, people are afraid to come back to work," and they have all these stats to prove it. From a personal note, I didn't really believe that. I think people were saving their pandemic stimulus checks, and they'll go back to work when their savings run out. I mean, nobody, if you're doing a poll on the streets, no one's going to admit that they're sitting back at home because they've got some savings in the bank. I think that is going to sort itself out. But a lot of people decided, because of the pandemic, they decided to retire. So that was a big issue with the labor. And it doesn't matter if you're a waiter in a restaurant, or a truck driver, or an engineer who doesn't want to get on the train to commute into work. That has been a problem for a while since the pandemic. And of course, because of labor shortage, we have labor costs, which again, that gets back into the other bad type of inflation. When the cost to produce anything goes up, those prices have to be passed on to the consumer. And accommodation costs are going up all over the world. You find a lot of companies are now actually relocating offices, if they have offices, or relocating employees to less expensive parts of the world, because of the pandemic, we all know we can all work remotely, which is wonderful. But all these lovely things have really, good, bad, or indifferent, have impacted inflation. So we'll call that pandemic inflation. So now we have UK war inflation, or Ukraine war inflation. I'm not the first one to make that mistake. Ukraine war inflation. And the big problem we have here is crude oil. The world has slapped tons and tons of sanctions on Russia to try and literally cripple their economy, to get them to stop this war, this invasion, this unnecessary invasion. But there is a lot of uncertainty around crude oil and natural gas. The natural gas and crude oil are still flowing. It's passing through Ukraine to get to Europe, and we're still in winter, obviously, at the time of this recording. So it's critically important. Natural gas, as I said earlier, is used to make fertilizer. So when this uncertainty crept into our lives, the price of natural gas shot up like crazy, and along with it followed crude. And there's still a lot of uncertainty as to whether this flow will continue. And there's a big logistical, philosophical problem right now, is that we're buying, especially the Germans, are buying a lot of Russian crude oil at a very high price, and they can't afford to turn off the taps because their entire economy will grind to a halt, which will be inflation on steroids if that's the case. So, and also, believe it or not, Ukraine actually makes a lot of money by this Russian crude and natural gas flowing through their country. So it's a bit of a conundrum, but the problem is right now, crude oil and natural gas are very, very expensive, which is actually making a huge knock-on effect to everything we do and everything we buy. Getting back to the man on the street, my electricity bills in Spain are shocking. It's just crazy how much we're paying for this. Right now, there's a strike on. Truck drivers are on strike because they're tired of paying so much for petrol, and this is happening all over the world. Okay, wheat. Right now, there's an uncertainty with all commodities because we don't know if one of the world's largest wheat producers, or two of them, Russia and the Ukraine, will be able to plant their crops. And again, if this doesn't happen, we'll be looking again by the end of the year, inflation on steroids. This could be a very, very bad situation. So fingers crossed that the Ukrainian farmers will be able to plant their crops. Also, something coming out of Russia, steel and iron ore are becoming increasingly expensive. Someone jokingly said steel is now a luxury item. And again, it's all because of the geopolitical events, getting stuff moved around. It's just everything is becoming more and more expensive, and inflation is spiraling, hopefully not out of control. Right. So now we've gone on about that. How do the central banks measure inflation? There's really no sort of inflation. There are rates, of course, but there's really no sort of inflation gauge that you can look at. And the way they measure it is with CPI. And and personal consumer expenditure. So here we have, and this is the economic calendar. And if you're a trader, you need to be looking at the economic calendar all the time. And if you've watched my videos or classes or webinars, you'll know that I don't stop talking about the economic calendar. But what I want to do right now is go through how the central banks and governments measure inflation. So we've got PCE, personal consumer expenditure, and CPI, and core CPI. So these come out monthly, they come out yearly, and they sometimes come out quarterly. And also, while we're talking about economic calendar, the FOMC press conferences after these consumer price index announcements and so forth are just as important for a trader. Okay, and that's the United States. In Canada and Great Britain, they have monthly CPI or homologized CPI as well, which is basically the same thing. The reason I'm showing you these three first is that these three economies, currencies as a trader and their indices are affected more by these figures than other economies, and I'm going to explain why. So if you're trading Canadian dollar, UK pound, or American dollar, you need to be aware of these figures. Not that the other currencies aren't affected by it, but these three economies are affected more by it. Okay, Australia and New Zealand have quarterly CPI, but their currencies are affected less. You're trading, and if you've been trading for any length of time, you'll know that the Australian dollar and the New Zealand dollar are affected more by the price of commodities and the state of play in China than they are by inflation figures. And of course, there's the euro, which is, obviously a very, very big economy. The thing about CPI in Europe is that these are listed generally country by country. And you can see on the calendar, we've got Spain month by month, Germany month by month, and France month by month. So it's not all necessarily built in together. So that's one of the things about trading the euro you need to keep in mind, not just in this case, is that a lot of these countries will announce their figures, whether it's retail sales or CPI or whatever, basically independently. One of the few things you'll find that the European Central Bank does on its own is the interest rate, which again, we'll talk about that in a few minutes. Okay, there is such a thing as the University of Michigan inflation expectations. These are based on the figures we've already talked about, and not that the market doesn't pay attention to them, but don't be fooled by the word inflation built into this report. It generally does not affect the price of the currency. You need to be paying attention to PCE, and CPI. Right, so what is CPI? So basically, Consumer Price Index looks at food and beverage, it looks at clothing, looks at education, looks at housing, looks at communications, hospital costs, leisure, and transportation. And there's quite a variety of, there are actually 200 more categories within those. And the US CPI, for example, looks at 80,000 items. So it's a very, very comprehensive look at how much the individual consumer is spending on a month-by-month or quarter-by-quarter basis. It's a very big project, and the investors, analysts, and the central banks take it very, very seriously, especially in times that we're in right now. You'll also see a thing called core CPI, and core CPI is the same as I mentioned earlier, but it doesn't look at food and beverage, alcohol, tobacco products, and energy. The reason is that those can be seasonal. Obviously, during the winter months in the Northern Hemisphere, we use more energy, and say during the holidays, we would consume more food and beverage and alcohol, so they take these things out. So core CPI and CPI are different animals, and the central banks look at these in different ways. So as a trader, what does all that mean? Well, basically, Consumer Price Index is a measure of the change in price to the consumer. And as you know, if you've watched any of my videos or even studied the economic calendar, the markets move not by the good or bad number of the CPI. It moves if the number is higher or lower than the actual predicted figure. Okay. And basically, the CPI affects quite a few things. It affects inflation, obviously, which is why we're having this discussion, but it also affects interest rates, which is what we want to see as traders. So here we are, and here's what you should be looking for on your economic calendars. Here's a typical case. This is this is pre-pandemic. So as I said earlier, central banks want to see 2% basically as a rate of inflation. And you can see what happened here. This particular one, the year-on-year CPI in Canada was 3%, which is way higher than analysts had predicted. So a green number means that it's going to increase the cost of living, which is inflation, which means that there could be an interest rate rise on the horizon, which means that the currency will increase. And here's what happened in this particular case. Sorry, I'll come to that chart in a second. So we want the governments and central banks to be fighting inflation before we talk about trading. Okay. So there's government intervention. This doesn't happen very often, but the government in extreme cases can introduce wage and price controls. I mean, this generally doesn't happen because government doesn't like to get involved in these things because it can cause unemployment and cause recessions if they just jump in and say, you've got rent control, or we're putting a cap on the price of petrol, or we're chucking subsidies at things. It can generally cause more trouble than it's worth. So in these cases, governments will typically not get involved, but the central banks do, and this is very, very important when we're dealing with inflation. So as we know, we're looking at increasing interest rates. And when you increase interest rates, basically spending falls. And when spending falls, that gets back into the supply and demand, and basically the prices will fall along with it. So if demand becomes less because people are buying less, then the price will fall. So that's one way to basically keep inflation under control, is by increasing interest rates. And also what it does when you increase interest rates, it means that the value of that currency, doesn't matter whether it's American dollars or British pounds, Canadian dollars, et cetera, becomes more valuable. You can actually import more with your dollar. So in that case, the price of the goods coming into the country are less. So that's one of the key tools that a central bank has to keep inflation under control, is increasing interest rates. And right now, increasing interest rates is a hot topic because, as we said earlier, for a year or so, the central banks, especially the Bank of England and the U.S. Federal Reserve, were saying, oh, it's only transitory. We're getting out of the pandemic. Well, they've realized it isn't transitory. It's actually a big problem. So we may find that we're seeing every single U.S. Federal Reserve meeting that Jerome Powell will be announcing interest rate rises. And what he wants to do is go 0.25% every time. He's getting criticism for that because people think it should be 0.5% every time. And that increases that opens up another kettle of fish, is that corporations don't like higher interest rates. It also takes money out of the pocket of the consumer if you've got a mortgage. So it's the job for the central banks right now is to get inflation under control. And also they're looking at decreasing bond purchasing. I mean, they've been talking about decreasing bond purchasing and they have started it, all the central banks, or most of the central banks. So basically it means that less money is going into the balance sheet, which means that the currency is higher. It means that you've got more money less money is being spent on goods, which will bring the cost of goods down. And there's also one more trick that they have, and they haven't talked about this yet, but increasing bank reserves. So if a bank has X amount of billions in their coffers, and the bank reserve requirement goes up, then the banks have less money to lend. So basically, then lending becomes more expensive, and the bank's interest rates go higher, and therefore people, may think twice about buying that new car or even a mortgage, and therefore the prices will stabilize and come down. So there's different tricks the central banks have. When you hear the news and they say the central banks are running out of tools, then it's time to worry. But we're not quite there yet, fortunately. So when we're trading interest rates or CPI or PCE, and I'm going to go back to my old order of analysis. A lot of you like to live, breathe technical analysis, but I can tell you right now from years of experience in trading, fundamental analysis outweighs technical analysis, and this is a very important case. So results from CPI, interest rate changes, FOMC meetings, any central bank press conferences, Christine Lagarde will outweigh any technical analysis. Once you've got the fundamentals under control, and we'll look at that in a minute, then we rely on support and resistance, and then chart patterns. And within that are trend lines, of course. So if you've got a fundamental event that drives price one way, and I'll talk about counter trend trading in a second, then once the fundamentals are out of the way, you know where price action is going. Then you can rely on your support and resistance and your chart patterns, other indicators, and even candle patterns to open a trade and close a trade. But before any of that happens, you need to be really seriously paying attention to the news, paying attention to Jerome Powell, Christine Lagarde, and Andrew Bailey, and seeing what's and looking at your economic calendar, and also plotting the trends. So getting back to that Canadian CPI number, sorry, give me 2 seconds, please. Here we had a case where CPI was higher than predicted. And again, the number in the middle is the forecast, and the number on the left in green is the actual announcement. If it was red, it would be below the number, the forecast. If it's green, it's higher than the number. So you can see that month-on-month CPI was basically 0.5 versus 0. And again, the central banks like to see 2%. And even core CPI was higher than they'd predicted month-on-month and year-on-year. So it was an upside surprise to the Canadian economy that this happened. And you can see now, looking at these various charts, what happened. That huge red candle went shooting down. I think if I remember, it was about 70 pips, 70 pips, which is quite a lot. And here, this is what you need to do as traders. If you want to trade these news events, and this is very important to why we have Valutrades has quite a few series on videos, for example, CPI, inflation, and news trading. So if you can go onto the YouTube channel and look for those 3 videos, it will basically encapsulate most of what I'm talking about right now. Obviously not so much on the Ukraine war or the pandemic, because these videos were made before that, but they will give you a very, very good solid foundation on how to trade news events. So here we have, and what you may not be able to read the actual fine print here on this Valutrades MT4 chart. Across the top, I have 3 Canadian pairs: dollar CAD, pound CAD, and euro CAD. The charts on the top are the 1 minute time frame. The charts on the bottom are the same pairs in the 1 hour time frame. And the reason I do that is I want to keep an eye on the overall trend. And the reason I do that, I don't want to jump into a news event and trade with the trend, because it could come to a crashing halt. As I said, this particular one went 70 pips. Doesn't always happen that way. It could go 10 pips, it could go 20 pips. You just don't know. And also the spreads, and Valutrades has very, very good spreads, but during times of high volatility, the spreads can be very high. So once the announcement comes out, don't go clicking the button to get into a trade, because you'll find out that your trade will be executed in a place you don't want to be. So you need to wait for the spreads to calm down. So this is what we do as news traders. And as a professional trader, I used to make my bread and butter trading news events. And my success rate on these events was far higher than swing trading. I can tell you that in all honesty. So let's take a look at which way this went. If you're looking at the hourly chart, you can see it's hard to gauge a trend, because price was stable, then went down and went back up again. And don't forget as well, the Canadian dollar in this particular case is the quote currency. So price action going down means the Canadian dollar is getting stronger. So let's take a look at what happened here. So this is dollar CAD. And you can see right now that if I look, and this is the 1 hour chart, so you're looking at a much bigger view. In fact, this is roughly the price action over 1 week. And you can see what had happened. Price eventually worked its way into a double top. And if you've been following our videos and lessons, you will know that double tops are a reversal pattern. So we were ready for some kind of reversal. In this case, the news helped us along. So we didn't want to trade this based solely on the double top. In fact, the double top didn't actually exist until the news event came out. So this gets back to my order of analysis. Fundamental analysis is more important than looking at the double top. In this case, it was a beautiful combination, because you can see where resistance was at the top of this orange box. That was our resistance. A double top had formed, and then when the news came out, it went crashing through support, And then by the time, this is the hourly chart, so this candle lasted this bear candle lasted 1 full hour. So you had plenty of time for the spreads to calm down, wait for price to crash through that line of support, which is the bottom of that orange box, and then carry on. And that is classic trading of a double top. Again, yes, you're right, we saw a trend going up, but a double top is a reversal pattern, so we were looking for price to reverse. So we had an excellent opportunity to take advantage of price movement, the Canadian dollar getting stronger based on really good CPI, or very high, CPI numbers. And again, high CPI numbers mean that inflation was going higher, and therefore the currency was getting stronger, because for two reasons. That could mean an upcoming interest rate rise, or in fact the buying power of the Canadian dollar. And you can see what happened in this case. There were a lot of fluctuations, but price did in fact carry on based on this double top reversal. So here's a classic opportunity of using fundamental analysis combined with technical analysis to make a really good trade. Okay, here we have another case where we're looking at a 5-minute chart and UK CPI, which was projected to be 2.6%, higher than the 2% that the central banks like to see. Suddenly, wham, came out the exact opposite. It was actually down less than 2.6%. So it was a red number. That doesn't mean it was negative 2.4%. It just means it was lower than the 2.6, and that really affected the pound. You can see that price fell from basically $1.31 down to almost basically an American penny price drop. So that's almost 100 pips. So it was quite a huge drop. That doesn't seem like much, 2.6 down to 2.4, but the fact that it was lower, and it was a yearly figure as well, not a monthly figure, really kicked the UK pound. But you can also see that it was trending down in the beginning on the 1 hour. So this is the 5-minute chart. Not that the 5-minute chart is any indication of a trend. It's not. Let's move forward a bit. Okay, here we are looking at the same trade on 15-minute charts. And basically what you have in this case is you can see every single pound pair lost value. It doesn't matter whether it was a pound dollar or pound yen, pound Aussie. So, and I like to, and of course euro pound went the other way because pound is the quote currency in this particular pair. When I'm trading something like this, I like to look at multiple currency pairs because not every trade is a viable one. And again, I'm going to show you why in a second. I want to trade counter trend, and not every single pair will have the same trend tied to it. Okay, here we have the same, looking at the hourly chart. So basically, price action went to the same direction as the trend. So I would not be interested in this trade at the time. But what I would be interested in, if you can take a look on the top left chart, which is cable, which is pound dollar, price did eventually come back and then reverse. So it actually went into a trend line and reverse. So I was trading with the trend. And the same thing happened with pound yen, not so much with pound Aussie, and a little bit in pound Swiss. So this is not a situation where I'd be trading that particular news event, and these are 1 hour charts. So it looks like about the next day where you had a viable trade to jump back in. So it's a case like this where we say trading the news doesn't necessarily mean you need to jump in when that news event happened. The best trade to take would be the day after that news event. So I'm going to repeat, price fell dramatically on the pound. Investors said, thank you very much for the bargain. They bought back in, and they drove price back up to a trend line, or back into the downtrend that was happening. So that would have been a much better trade to take the day after the news event. Okay, and you'll hear me say this a million times in my life or your life, counter trend move. And this is the classic news trading. So basically we've got 15-minute chart, 1 hour chart, 4 hour chart, whatever you like to call a trend. And this particular pair had been trending up. And then suddenly a news event came up, could it be CPI or whatever, and price fell dramatically. What this means, and in fact, you can see that it hit a level of support and then reversed. So what this means, when price falls this dramatically, and the price went from 109 down to it dropped about looks like about half a cent in this particular pair. This is euro dollar, so euro fell 1/2 a cent, so 50 pips in this case, which doesn't seem like much, but it's quite a lot depending on the news event. Drove price back down to support. Investors said, thank you very much. And all the computers who were trying to buy euro at the time said, hey, great, that's the price I wanted, and price went skyrocketing. So when I talk about counter trend moves, this is exactly what you should be looking for, a move that goes in the opposite direction of the prevailing trend. I'm going to repeat, a counter trend move goes in the opposite direction of the prevailing trend, and this is the best way to trade news events. Doesn't matter whether it's inflation or interest rates or whatever. In fact, interest rates are if you're careful, one of the best ways to trade. Interest rate decisions are very often made based on CPI and inflation data. So it all ties together. Okay, so basically, and again, I'm going to be saying this over and over again, as long as you hear me or know me, you need to look at your economic calendar. And here's an economic calendar. And if you know anything about economic calendars, this one is several months in advance because it has no forecast or previous on it. But what's interesting about this, if you look at this, you've got the Australian dollar, Australian Reserve Bank of Australia announcing their rates. You've got the American FOMC and which is the U.S. Federal Reserve announcing its interest rates, and you've got the Bank of England (GBP) announcing their interest rates. You've got 1 week full of employment data. This is also the non-farm payrolls are on there, but you've got 3 major reserve banks, central banks, announcing their interest rates, and they will be studying their brains out about inflation before they make these announcements. And you also see on the on this economic calendar, statements and press conferences. And I can tell you as a trader, I've actually made more money on the press conferences than I have on the actual news events. And the reason is investors are watching and waiting, and there are, believe it or not, computer programs listening to the central bank governors, whether it's Jerome Powell or Christine Lagarde, or in a few years ago, Mario Draghi. Basically what they're saying, what word by word, where they're using words like maybe or probably to gauge which way that currency is going to go. And you can actually do very, very well if you're paying attention, and again, trade counter trend. So if Jerome Powell says something during a press conference, drives price counter trend, watch where it goes, watch your support and resistance, watch your trend lines, and you've got a great opportunity to jump into a trade. And there are no guarantees in this world. Again, read the risk disclaimer on the Valutrades website. But I can tell you as a professional trader, these little tricks are invaluable. And in fact, so many students I've said, I want you to watch the press conference tonight. And they're, oh, do I want to watch the press conference? And the next day they'll say, wow. So if you watch, doesn't matter who it is, Christine Lagarde or Jerome Powell, and watch the charts next to it on the 1 minute or 5 minute time frame, you'll know exactly what I'm talking about. And again, right now, in the world we're living in, inflation and CPI and PCE are critical in the minds of the central banks. So if you need to know more about these things on a day-to-day basis, I mean, I have the luxury of having 5 or 6 monitors on my desk, and I have Bloomberg going all day long. You may not have that luxury at work, but you can certainly catch the news and see what's been happening with the central banks and what they're predicting. Even Google Bloomberg. I've got a Bloomberg app subscription that I follow, every day. Yahoo Finance. Watch the blogs and so forth on Valutrades that we create on a regular basis. CNBC, there are lots of ways you can find out information and see what's going on. You may not be able to predict the markets, and again, watch these videos on inflation on the Valutrades YouTube channel, inflation, CPI, and news trading, and that will give you a very, very good foundation as to what to follow, and how to get involved in trading these events. It's not easy. It takes some experience. Don't trade more money than you can afford to lose. And again, really keep in mind, and I'm going to harping on about this because we are in very bizarre times. Even the central banks don't know what to do next because we've got so many geopolitical events going on coming out of the pandemic. We're learning as we go along. And one more thing I'll mention, I mentioned this earlier, if you don't have the time to follow all these things, then you can definitely use value trade signals, because the guys and girls that make value trade signals also look at inflation, they look at interest rates, they follow the central banks, they follow CPI, they know when the volatility is coming up because they have that experience. So if you don't have the time or the patience to follow all the things I talked about during this webinar, you can use value trade signals. Okay, that's it. If you have any questions, you can jump on the question line right now. If not, you can fire off questions onto the Valutrades customer support chat line, and we can get back to you as soon as we can if you have any questions. So anyway, I hope you enjoyed that. I hope it was valuable. Hope inflation isn't ruining your life, never mind as being a trader, but as a guy on the street like we all are. Let's wait for our next electricity bill and next time we fill up our cars and trucks, and hope it isn't going to break us. Thanks again for watching, and we'll see you soon.